Hello, I'm Jackie Lockie, and I'm the Head of Training at the AIC. Today's short session will look at liquid and illiquid assets. So our learning objectives for this session is to look at what is meant by share price liquidity, and then identify the factors that will affect the underlying portfolio in terms of liquidity, and finally to look at the implications of liquid and illiquid portfolios. So firstly, let's look at exactly what is liquidity. What do we mean when we say liquidity? Well, we mean how easy is it to buy or sell the shares that you want in the quantity that you want without moving the price. Now, to be clear, this is not to be confused with the terms liquid and illiquid assets, because for liquid and illiquid assets, we're going to look at what's inside the portfolio itself. So let's start with liquid assets. So those are assets that can be bought and sold freely. They are often stock market securities. The automatic price matching systems will continually make a price of which you can buy. Remember that certain securities have T+1 or even T+3 days for settlement. And gilts are also liquid assets, and we buy those normally from the debt management office. Now, liquid assets. These are assets that are not very easily traded. So things like physical property, maybe infrastructure, although not shares in infrastructure companies, the direct underlying holding. Even term deposit accounts, so where you don't have instant access to cash in a particular account, can be treated as an illiquid asset. So think about when you're constructing a timeline or a cash flow for your clients, when do they need the money? You never want to be a full seller of equities in any event, whether they're liquid or illiquid assets. You will always be able to sell liquid assets, but think about what price. So for example, if a particular sector that you're investing in, say property, as we've seen in previous years, whether that market is currently depressed, you will be able to sell your property investment. However, the price may be significantly lower than you would anticipate. So there are a number of things to think about. One of those things is what sort of data you need in order to be able to establish if you have a liquidity issue. So see the AIC website for trading volume data and other issues surrounding that. Costs of dealing are also important, and consider that actually illiquid assets are very important. They really come into their own for closed-ended structures such as investment companies. So as far as investment companies go, there is a wide variety of different types of companies out there. Some are fully liquid and their underlying portfolios are fully liquid, so they're traded on a recognized stock exchange. In the underlying portfolios, some hold fully liquid assets, but others are part illiquid. So things like private equity or direct property. Venture capital trusts, or VCTs, are a separate issue entirely. So some things to think about then. Think about your clients' objectives. When do they actually need the money? What returns do they need from their underlying portfolios to meet those objectives? And then look at the suitable asset classes that there are out there to meet those expected returns. Are they liquid or maybe illiquid assets? Most importantly, don't put all your eggs in one basket. So in summary, we've looked at what is meant by share price liquidity. We've looked at the factors that affect the underlying portfolio in terms of liquidity, and also the implications of liquid and illiquid portfolios. Thank you for watching.